So let's dive in. Tax planning. I'm going to kind of use an example. You're going to see me do this. I'm just going to vocalize it, then I'll write it down later. But individuals earn money and then we get taxed on it and then we spend what's left. So a lot of you guys are used to, hey, I go out there, I pull a paycheck, and when I come home, I get whatever's left of it. There's OA, Social Security, FICA, Buddha, Suda, all these things that come out of it. There's federal tax withholding, all these things come out of it, and then I get what's left over. So I remember working for McDonald's when I was 16. I got $4.15 an hour. And when I got paid, I didn't get $160 a week. I got like 120. There's all these things that were coming out of it. And that's because individuals earn money, then they tax us, and then we get to spend what's left. And just flip it on its head. Just those second two items. On a business, we earn money, then we spend it. And then we're taxed on what's left. And that's why there's such a huge difference. If we can just move things in that spend category that are before the tax, it makes a tremendous difference. Here's an individual and here's a business. And I said I would write down the earn, tax, spend. Businesses earn, spend, and then they're taxed. We just want to spend a whole bunch of stuff that's deductible in our business. We also want to be careful over here. See, here's you. I'm very interested in what you're earning. I'm also very interested in what you're earning on investments over here, right? I like that business side. I like the real estate side because the spend, I may not even have had to spend it. Like I could have bought the property. That's my spend. I could have repairs. That's my spend. I get to write a whole bunch of stuff off. I can accelerate it. I can take it all now. I could have a huge deduction in year one. That's my spend. And what does it do to my taxable income? It squishes it. Sometimes it eliminates it. When I make money over here and I start earning, maybe I don't want to make income that hurts me. And let me explain. We have multiple types of income. If you go through this, by the way, guys, you're going to know more than 90% of the accountants out there. They've all learned this and forgotten it since they went to school. You have earned income, and earned income, you're taxed at your ordinary rate, which is 0 to 37%, your federal rate. You got state also. And you get Social Security. Which is 15.3%. 12.4% old age disability and survivors, 2.9% Medicare. If you work for an employer, they're paying half, you're paying half. If you work for yourself, you're paying the entirety. But the reason I bring it up there is because no other type of income has Social Security taxes on it, only your earned income. If I just know that, then it's going to tell me, wait a second, every time I go out and I earn $1, they're doing this to you. Whack. So, and I should say this, every time you earn a taxable dollar, especially as a W-2, the IRS is literally like the nun in Catholic school walking around with a ruler. And every time you get your paycheck, they're whacking you on the knuckles. I went to Catholic school, so I can relate to this. How many of you guys went to Catholic school? You remember the penguins with the rulers, and sometimes they threw erasers. Sometimes they grab your ear. Right. You're getting a little whack. And I want you to think of the IRS as a penguin walking around, ready to give you a little whack. I don't want to be disrespectful to them. The mothers are great, wonderful people, but they do hit hard. So every time you're getting a paycheck, I just want you just to visualize somebody's just giving you a little whack, unless you can put it someplace where it's not going to be taxable or you can offset it. But the other types of income, there's only two. Portfolio income is one of them, and it's your investment types of income. It's going to have royalties, which are taxed at ordinary rates. No Social Security. Interest, ordinary rate. No Social Security unless you're a bank, unless that's what you're doing for a living. Dividends, oh, dividend. dividends can get fun. If you're a US company and you're getting dividends, let's see how many people know this. It's taxed at 0, 15, or 20%. It's taxed as long-term capital gains. And again, there's no Social Security. That's a qualified dividend. There's ordinary dividends. If you have like a master limited part or master partnership, master limited partnership, or you're working for an employer and they're paying you, well, actually, in that particular case, it's going to be compensation. It's going to be up here. But if you're getting qualified dividends, even out of your closely held C Corp, you have your own company and you're paying 0, 15, or 20%, depending on your income. Now, I'm just going to jump ahead and show you, oops, not that. I'm going to jump ahead and show you the rates. If you are married, filing jointly, and you have the long-term capital gains rates, you can make up to $94,000 and you're at the 0% category. 94 to 583, you're at the 15% category. So right away, you guys should be going, oh, that's not the nun giving me a whack. That's the nun saying, good job, giving you an attaboy, giving you you're fantastic, getting you 100% A+, whatever you want to, telling you that you're benevolent, giving you some kudos, whatever it is. The IRS is going, good job. Those dividends that I just made, that's fantastic. And I already can hear your accountant rolling around going, you double checks. If you're investing in things, you should be getting paid to invest in it. I'm not going to invest in something that's not going to pay me. And I like investing in things that pay me dividends. Why? Because it's a lower tax rate than my ordinary rate. My ordinary rate's up 37%. My dividends are at 20%. You do have the net investment income tax, so it's an extra 3.8 in some cases, depending on how much you make. But I'm not horrifically worried about that. What I'm thinking about is it's like half the tax. It's literally the IRS is going, psst, do that, right? That's taxes. That's tax planning. What type of income should I be making? Hey, I need this much money to live. How do I get that much cash in my account? It doesn't matter whether it's taxable. Maybe it's taxed as dividends. Maybe it's 0. I just need to know, hey, how do I get that so I could pay that? Taxes should be that. That should be your tax planning. Capital gains, you already got introduced to long-term capital gains. There's also short-term, which is when you hold an asset for less than 1 year. And that one is taxed as ordinary. So if you're somebody who likes to write covered calls, you know that's ordinary income. So we like to try to shelter our ordinary income. A lot of you guys might be going, wait a second, there's a lot of ordinary incomes. Yep. Why do you think we have management corporations? Because we are going to go back here. I'll go back to this, and we're going to try to spend it. We're earning our money with portfolio income and investments, and we're going to try to spend it away so that we pay very little in tax. Hopefully you guys already see where I'm going without me even having to tell you, right? Isn't that fun? I like it. And then there's passive income. Everybody likes to call all of these passive income, but they're not. Passive income, there's only 2 types. There's rents and there's business income with no participation. You're not materially participation. Both of which are ordinary, neither of which has employment taxes. Now, the reason passive income is such a buzzword is because passive losses, when you create passive losses, they can only be used to offset passive income with a few exceptions. And those exceptions, the big ones are real estate professional status, doing short-term rentals, active participation. What I like to do is have passive losses. And then if I have capital gains on a passive activity, like a syndication gets sold, those are considered passive capital gains, in which case then I can use my losses from my rental properties to offset that gain and not pay any tax on it. Again, I know I just heard some heads explode. Got to hang out with us, guys.